What is going on, Hot Take Nation? It is DRW here, and this is a show I have been looking forward to since my brief interlude on Twitter. And I will admit that even though I don't have a Twitter account anymore, there's one person I go and check every day, and that is our guest today, Art Berman. Art, welcome to the show. So good to have you.
It's good to be here, David. Thanks for inviting me.
So, I mean, you're quite a legend, and you pump out some of the most technical analysis that I see on Twitter, and you use your real name, and you have the website, you have the subscription, and you've really, in my opinion, you kind of called going into 2020, certainly on the oil side, that there was a lot of oil out there, and you were very skeptical of prices in the 50s at the time, if I recall correctly. Is that a fair characterization as how you viewed the world in January?
Yeah, that's right. I mean, basically, the world has been on OPEC plus life support for in January for 3 years, and so when a patient's on life support and he or she seems to be doing well, vital signs are good, and all of that. Well, that's great, but what would happen if the patient decided to get up and leave the hospital? Well, not so good. And so that's something that people in general, and certainly a lot of people in the oil business, just forget. They think everything is fine, and they just somehow ignore the fact that OPEC plus was withholding almost 2 million barrels a day for 3 years. And so when things happened, like the Saudi refinery at Gawar was attacked and oil prices went up, a little bit for a couple of days and then went back down, people were saying, what the heck? I mean, this is crazy. No, it's not, because the market's smart and the market knows that there's a lot of extra supply out there that's just not being used. And so it freaked out a little bit, but that's just price discovery. And that's another thing that people get this idea that the market has it wrong when something happens, like price goes up a lot for a couple of days, then goes down. No, that's just price discovery. And what price discovery is, let's see if there's a fool on the other side of this trade who actually thinks that because this refinery was attacked, that oil prices are going to go to $150. I mean, maybe I shouldn't say it's a fool, but that's the way the guy on the other side of the trade looks at it. And sure enough, they found enough guys out there who believe that the price went up for a couple of days, but those guys got wise, and everybody else said, "Nah, we're not worried," and so the price went back down. So, the idea that the market gets it wrong. Who's the market? I mean, the market's you, the market's me, the market's everybody who's listening. It's the collective knowledge and understanding. And yeah, we get things wrong from time to time, but just because the market prices oil higher than I think it should be doesn't mean the market's wrong. It means it's doing what markets do. It's figuring out what price are people actually willing to pay for a barrel of oil.
So it's interesting because certainly I 100% agree with you that the subsidies of OPEC, for the right or for the wrong, and obviously oil producers, to the extent they thought about supply demand, they sort of had a view that Saudi was always going to back off oil production. The U.S. was going to grow. We were going to grow our way out of debt, and for a variety of reasons, COVID, debt, etc., that thesis blew up. And I saw some work on the I think it was on Late Week that you did, and you sort of talk about mean reversion. And one of the things I really like about your process is that the statistics you come into with net longs and net shorts and some of the data flow to kind of really pin down supply demand and what you're thinking. How did you come up with that? Because I haven't seen anyone else really doing it, and how meaningful is it in a world that the Fed is injecting liquidity and people are looking for assets to buy, and crude is an asset? So how does all of that factor into your analysis and your conclusions?
I wish I could give you a succinct answer, and how I don't know. I mean, I just look at everything. I mean, I'm one person, I don't have a staff. Um, and I try to look, I mean, obviously, I don't look at every single thing, but I look at everything that over my 40 plus years in this business, I've learned are important. And, sometimes I miss stuff. Sometimes I, decide for some reason, bias probably, that, well, I don't really need to take a look at, what our, you know, Gulf Coast Pad 3 comparative inventories this week because clearly something. And then I look at it a few weeks later and then, oh my God, why didn't I do that? Because but the point is that there's no silver bullet. I mean, there's no single thing or small group of things that I look at that tell me what's happening in the market. I mean, it's as complex as the human mind, and it's only by integrating lots and lots of pieces. And oh, by the way, listening to what other people think. I mean, I'm on Twitter, obviously partially to advertise myself to some extent, but more importantly to find out what other people are thinking. And there's people that come from completely different experiences, refiners and oil traders, and God knows it, journalists. And not that I believe everything they're saying, but I listen to it and I say, well, that makes sense, or that doesn't make sense. So looking at things like long and short positions on managed money, that's an interesting thing to look at. It's always a week in arrears, so you have to process that through. By itself, what does that say? Well, sometimes a lot, sometimes a little. And ultimately I have to process that. I mean, like just looking at net long positions, for instance, the longs minus the shorts. Well, you have to normalize that for how much open interest there is. I mean, if you're looking at any significant time period, how many contracts are out there? So if they're, let's just say they were, three times as many contracts in 2018 as there are today, and that number is not exact, but there were a whole lot more. Well, you got to normalize that open interest, that net long, to the fact that there's a whole lot fewer people holding contracts today. And when you do all that, certain things emerge. But by far the the tool that I use the most for calibration is comparative inventory. And that's just looking at current storage levels compared to the 5-year average. And you would think that that's a pretty straightforward, simple thing to do that everybody would do, but they don't. Don't ask me why. I'm like the only person, at least publicly, that puts that information out there. And
Yeah.
if you look at the EIA website, they always show, what the 5-year average is for gas or for oil, but there just aren't a heck of a lot of people, I don't think, that do anything other than say, oh, okay, we're higher, we're lower, whatever. But that's it's the most important single tool I have. Again, it's not a silver bullet, but it's a great way of sort of leveling or equalizing all these dozens or hundreds of other factors I consider.
So before we pivot to talking about natural gas, because I really like, and for the listeners who don't follow Art at artberman.com, I really suggest that you do, and certainly follow him on LinkedIn, because his articles that he comes out with, and it's probably once a week, once every 2 weeks, but they're really thoughtful and insightful, and they sort of summarize the data position. And one of them about a month and a half ago was sort of like, oil is dead. Kind of. And I think on that, I can't remember the exact title, but you and I are, I think, very much aligned in terms of the U.S. oil industry. The end of OPEC and the amount of storage that there is has a significant dampening effect on oil. One of the things that I had sort of perceived would happen as associated gas alongside the 4 million barrels a day of oil that I think declines in the next year and a half, that takes 15 to 20 BCF a day off the market. You don't have strong prompt month pricing to be able to support a significant drilling. And so firm transport aside, it looked like gas was going to come down, 20 BCF a day-ish maybe rebalance the market in an electricity neutral world. And you really didn't agree with that thesis and came out with something about natural gas, sort of like the bulls are wrong. Let's talk about your natural gas thesis and how maybe it differs from the market, which really ran natural gas players up from March until recently on this bull gas thesis.
And they were so wrong.
Yeah.
I mean, gas prices last week were lower than they've ever been. We were down to $1.50 per MMBTU, and that's, I mean, I haven't done the CPI adjustment, but I mean, that's the lowest prices have been at least since back in the 1990s. So
Now, why is that? Because, and again, I think that the real thing in natural gas, like I'm a natural gas bull in the 12 to 18 month period, certainly not now. And then there's a company valuation, company leverage, like how do you play it? So I wasn't surprised in the short term, but I really didn't expect a $1.48. And then even more confusing to me is like 12 months out, it's 250 in terms of the strip.
right. Well, so I mean, your logic about associated gas from tight oil going down is airtight, and there's no problem there. The problem is that that's just one piece of the story, and so you got to look at consumption, and you have to look at demand, and so demand, is different than consumption because demand is consumption plus net exports and also some movements in and out of storage. But so the US is exporting, like 9 BCF a day right now, or well, as of recently, today is less. But but that's ultimately part of our supply. And all of those export approvals are conditional on the Department of Energy saying, this doesn't in any way threaten the well-being and security of the United States. Now, I'm not suggesting that they're going to pull those approvals, but the other part of all this is that natural gas demand and price in the world is way down. And so, I mean, the price in Europe is like 10 cents more than the Henry Hub spot price in the United States. Well, that doesn't come close to covering transport costs and liquefaction costs and all of that. So overseas buyers are canceling contracts on LNG right and left. And so suddenly a whole bunch of that 9 BCF a day is now available for domestic consumption. I mean, the market's flooded with natural gas. The consumption side, okay, so production goes down, but what about consumption? Well, I mean, we're in a depression right now. So should it surprise anyone that we're going to consume less gas? Doesn't surprise me. What about weather? We had one of the coolest Mays on record, which means that people weren't using their air conditioning very much. And so, you put all those pieces together, and what you ended up with was less than $1.50 per MCF, and all the gas bulls are saying, what the heck? How did that happen? Well, like you said, I wasn't calling it. I was just saying this is the reality. And then I go through the process of saying, well, I don't believe anybody's forecasts, but let's just take EIA's consumption and production forecast, run it forward, and seasonally adjust it. You have to seasonally adjust gas because the highs and lows of consumption are just extreme, with winter and summer. And you go ahead and do that, and the answer is, if you believe something as far out as 2021, and I don't, then we might have a little bit of a shortage right around the end of 2021. But again, you've got all this, you don't know is the main thing, but
Yeah.
You got all this export that you could pull back if you, assuming that it's even out there. And that says to me, I don't see a problem.
It's really interesting because like hedging to me has come back, and you've had a 40-year career, I've had a 20-year career. So you saw sort of, if I do the math right, you were through the downturn in the 80s.
Yep.
And I'm curious, if we start there, how do you compare and contrast what you think was going on in the 80s and with the benefit of hindsight and what's going on now? Because a lot of people would say, well, this is, our industry's cyclical, and in the 80s it went down and then it came back and everything was great. And now here we are. What do you say to those people?
Talking just about natural gas or
Let's go natural gas and oil, I think, just as a industry.
well, okay. So, I mean, there's a human tendency. My first degree was in history. There's a human tendency to always believe that what's happening right now is somehow completely different than what's ever happened before. And to add to that, human beings are now uniquely capable of destroying the entire universe, which we were never capable of doing before. And if you go back all the way to, to the earliest writings, if you go back to Socrates, he said the same thing. Kids today don't respect their elders. Our education system's going down the toilet. Things have never been any worse, et cetera, et cetera. So first of all, you have to discount your way through that and say that, yeah, that's just the arrogant human mind thinking that things are, we are the pinnacle. And so why is the oil and gas business cyclical? It's cyclical because producers are not very good at figuring out what the right amount of drilling and production is. And so if you give them a lot of money, so let's just say they're, in the 1970s, we had some real serious natural gas shortages in the United States. Okay, so all of a sudden there was a ton of money available for drilling, and we overshot. And plus we discovered we could, I don't know why we didn't know this before. Oh, by the way, Canada's got a ton of gas. Why don't we import gas from Canada? And so, just at the time that we were building LNG import terminals like crazy, all of a sudden we had too much gas. And all those import terminals were shut and used for gas storage. Same thing happened in the early 2000s. Oh my God, we're running out of gas. What's going to happen? Here come the LNG terminals again. Everybody's putting money into them. Shale gas came along. LNG terminals are not doing anything. They closed. Okay. So, in a way, for natural gas, if you want to play the market, whatever the LNG guys are doing, go the other way. They're always 180 degrees out of sync. And so recently, LNG export has been the wave. And an awful lot of the capital, the investor capital that was going into the Permian Basin and whatever, moved over. And $15 billion or something like that were put into a couple of new export terminals in Louisiana in the fourth quarter and the first quarter of this year. All of a sudden, nobody wants the LNG. Whoops. So again, if you want a quick thumbnail, look at what the LNG guys are doing and do the opposite. On the oil side, it's the same thing. We had the oil shocks of the 1970s. Supply went down, price went way up. Everybody's a genius. Hey, let's put a bunch of money into the oil business. We can't lose. Well, eventually we discovered the North Sea. We discovered a whole bunch of oil in Western Siberia, Mexico, China. And all of a sudden we got more oil than we know what to do with. And the world was oversupplied for almost 20 years. So, the cycles are not, they're not some sort of, planetary wobble, Milankovitch cycles or voodoo. They've got to do with human behavior, mostly producer behavior. Give producers money and they will spend it, regardless of whether it makes sense or not.
It's really interesting, right? Because when you take that in the context of everything, and we talk about the efficiency of capitalism, and that the markets are so efficient and you can deploy capital into opportunities and it goes. But, I remember my career was starting in the 2000 tech burst. And same thing, all these dollars, and nothing is ever destroyed slowly. It seems like same in 2008. Everything goes along up 0.25% a day for however long the bull market goes, and then when it comes down, it turns around incredibly quick. And that's what happened in March. So when you think about all of the supply demand and the national oil companies that control supply and OPEC that controls supply, and then the fragmentation of the U.S. market. A lot of people on Twitter, the EFT band, who I'm sure you read sometimes for humor and sometimes I don't even know. Sometimes I feel like it's like self-flagellation, but they really are against shale and sort of the shale Ponzi scheme and reserve auditors and just a lot of commentary on that. How do you weigh in on the way the U.S. market evolved and what's next for energy in the U.S.?
Well, markets don't always get things right, but one thing you can say about markets is they are ruthless. Okay, and so if they think they get things wrong, when they correct, man, they correct like crazy. Markets hate to pay too much for anything, and so my sense is that um, everything that's happening right now with COVID and everything is simply an acceleration of factors that were already there. These are, to use a cliche, these are all the cans that we've kicked down the road forever. The biggest one, of course, is debt.
Yeah.
Debt of any sort you want to talk about.
Yeah, in any industry, honestly.
Debt, whatever.
Yeah.
And so if you keep solving your debt problems with more debt, eventually it's going to come back and bite you in the ass. But specifically to your question about the shale companies and the SEC, I was just interviewed by a woman at Bloomberg who just published an article on this, and she was surprised.
Is this my favorite Bloomberg author, Rachel Adams Heard?
Yes, it is.
Yeah, I like her a lot. I've chatted with her in the past too. She's great.
She's a really perceptive person, and
absolutely.
I think she gets it right a lot of the time. But she just published this last week, and she talked to all kinds of people, and I think she probably talked to me last or near last for some reason. And she said, well, you're a big critic of tight oil and shale gas. And I said, well, no, I'm not a critic. I'm a critic of the economics. I'm not against the plays. I'm not against the companies. But if the economics don't work, I'm going to say that. And for the most part, they haven't worked very well. Now, in fairness, that can be said about the oil business and the natural gas business historically. The free cash flow is almost never there. So, let's not discriminate. Again, we think that today is somehow different than before. But the truth is that the oil and gas business has never returned a lot to investors, and now is not different. So she asked me, she said, well, do you think, like most of the people I interviewed, that the SEC should have done something about this? I'm on an interview. Sorry about that.
No, I love it. This is the work from home culture now. So it's either a dog barking or people asking questions. I'm surprised my kids.
You'll get the dog before long too. We got workmen in the house, etc.
Love it.
I told her, I said, look, I've been summoned by the SEC. I was on Larry Kudlow's show back in 2011, back when he was a
capitalist,
shock jock. Yeah, Larry Kudlow, who's now Trump's advisor on economics. He used to have a show.
I remember.
And he had me on there, and his show was about getting people with two completely different views to fight with each other. That was his deal. And so he had a guy who was big on the Marcellus Shale, and he had me. And, we didn't fight. We argued with each other. And Larry tried to get, wasn't bloody enough for him. And so he said, well, Art, you think that these shale gas companies are all Ponzi schemes, don't you? And I said, no, I don't. Absolutely not. And it really hacked him off because he thought, well, for sure I can get something ugly going here. And I said, look, Larry, a Ponzi scheme is something very specific. It's a financial arrangement where there's no asset, where the only asset is somebody's money. And so, I get a new investor and I give his investment money to an old investor who thinks that he's making a profit. I said, for all the questionable ethics and economics of shale gas, and this applies to tight oil, it's not a Ponzi scheme. I'm sorry. I mean, these companies, they have real assets and they go out and they raise money by, like any other public company. They issue bonds, they sell stock, they get loans, then they actually have cash flow. So no, it's not a Ponzi scheme. And he said, well, so, what do you think? And I said, well, it's real simple. I said, the companies tell investors one thing and they tell the government something else, and it can't be both. I want to know which it is. So that was on a Thursday or Friday, and on a Monday morning, I got a call from someone with the enforcement division at the SEC. And she said, we'd really like to talk to you.
Yeah, that's like getting that thick letter from the IRS. I imagine that even if you've done nothing wrong, when anything arrives at your house from the IRS, it raises the blood pressure. I'm sure, other than Elon Musk, I think everyone else would get a letter from the SEC or get a phone call and be like, I want no part of whatever it is that you're trying to sell me, right?
Well, it was a little unnerving, but I mean, it wasn't a subpoena. It was a request. And so I said, yeah, sure, I'll come up there. And I got on a plane to Fort Worth, and I just went through and I showed them. I said, well, here's an investor presentation from Company X in September of whatever year that, or, the year before. And they said they were making a 60% internal rate of return on some play. And here's their 10K filing to you guys for the same year at the same gas price. And they took $1 billion impairment.
Yeah.
Which says that they were making less than a 10% return. So my question is, which is it? Are you making 60 or 70%, or are you making less than 10%? Both cannot be true. And so we went through all this kind of stuff. And, I wasn't attacking any companies. I was just giving them information. And at the end of I walked out of there and said, well, I don't think they're going to do anything, because it's a tiny little staff of people. But in fact, they did do something, and they called some companies in, and they didn't punish anyone. They didn't fine anyone. They just asked them questions. And this is public record. And a lot of the abusive kind of things that I was complaining about, they went away. So, in my opinion, the SEC did what it was supposed to do, maybe more than it was required to do. And basically, buyer beware. You want to invest in a shale gas or a tight oil company, check it out. I mean, look into the company. If you don't feel qualified, maybe you shouldn't invest in them. But, you wouldn't go buy a house without paying an inspector $250 to take a look at the house. He's an expert. You're not. He's going to show you, maybe cracks in the foundation, a roof that leaks. Call somebody. Call me, there's thousands of people like me. Say, hey, I'm thinking about putting some money in this company. What do you think? And that doesn't mean you get the right answer, but just like getting your house inspected.
Well, it's funny that you talk
very
about that.
Sympathetic to people who later on say, oh man, I got screwed. Well, did you?
Yeah, you were looking for easy money without the work, and that the stock market. I mean, and certainly we've started reading about this. I don't know the level of magnitude, but sort of they're calling it the Portnoy effect, which is again back to 1999 when young people saw the stock market going, and young, old, everybody saw the stock market going up every day, and they thought they could just buy, and it was like the path to easy money. And, as we've seen, people get into crazy derivatives, or they risk more than they can actually afford. And they don't recognize that at the end of the day, the stock market, certainly the public markets, are a bit of a gambling exercise, because you don't have the information, you don't have the expertise, and you're competing against computers and people who make billions of dollars to do this for a living. And you think that, maybe you make a couple right calls, but it can be painful on the way down. The SEC comment's really interesting to me because in 2014, I gave my first speech. It was in Denver, and you can imagine the response. It was called The Death of the Bakken. And it was October 2014. Oil had just started falling, and I think at the time oil was 82. And I said to this room of 50 people, I said, oil's going to hit 75 and rigs in the Bakken are going to go from 220 to like 50, because they've been talking about spacing that doesn't make sense. Like it's more like 2 and 2 or 3 and 3. It sure as heck isn't 6, 6, 6, 6 and 6 and all the benches that don't exist. And so they will cover up their mistake. And Continental in particular had just found the Springer play. They'd produced 6 wells for 30 days and they were going to put 10 rigs in the Springer. And I was like, if ever there was an evidence, plus the Whiting Kodiak zero premium merger, all equity, if there ever was evidence that a basin was done, that was it. And everyone looked at me like I was crazy. Oil obviously hit $30. And so I've really had trouble with the valuation of public companies going back to 2014. When you think about valuations today and the next year or 2 years and SEC and valuations and prices and economics, what do you think happens to the industry and to companies in terms of a reversion to the mean that you talk about? Like the data's out there and markets will eventually get it right. What do you think happens?
Well, I think a lot of companies end up being the property of the United States. I just, just before we got on this call together, I was getting ready for a webinar I'm giving on Thursday, and I was looking through Bakken, Continental, and Whiting, and Oasis, and EOG, and just looking at their 2019 10Ks and figuring out, and anybody can do this. Most people don't know how, but in their 10Ks, their SEC annual filings, there's an item called the standardized measure.
I love it. The only other smog guy on earth. I got so much crap from Twitter on the smog, but carry on. I love it. Preach.
The smog, the standardized measure of oil and gas. So companies, I don't know if they're required to or if they just do it, but they run through a discounted future cash flow from their proved reserves in their annual filings. And so if you know enough to go back then and say, well, okay, what are the reserves that they used for that? You know what the SEC price is, then you can calculate or you can back calculate what their real break-even price is. And then if you add in their operating expenses, which are not included in that, then you come up with a true break-even price. So, I'm not looking at the spreadsheet right now, but looking at, Oasis and Continental, both of them were over $60 a barrel, which is exactly what my bottom-up calculations, actually looking at reserves and looking at drilling costs and et cetera. So we're at, we're at 35, let's say, or so. And of course, in the Williston Basin, they're getting probably $6 or $7 less at the wellhead than whatever WTI is. So let's just give them benefit of the doubt and say they're getting $35, which they're not. Well, if it takes them 60 or 65 to break even after their operating expenses, then they're losing $30 on every barrel of oil if they're getting wellhead. Now, if they're hedged, of course, they're getting more, and that's important to look at, but they're not hedged on 100% of their production, and they're not hedged forever. So, what that says is that companies that have a lot of debt and have had to shut in production, and and I think most of it's back on now, at some point, they can't pay their interest expense because they're losing so much money. If they can't pay their interest expense, they're going to have to default. And who's going to buy them? In the past, back in 2016, the oil industry was in depression, but the overall economy was reasonably good, propped up by a bunch of debt, of course, but whatever. And so there were plenty of people, companies and private equity and whatever, who were eager to swoop in and buy up these companies on pennies on the dollar. I don't think that's the case today. Everybody thinks that Chevron and Exxon are just salivating in the wings, waiting to buy up, an Oasis or a Whiting or whatever. Boy, I'd sure be surprised if they are.
It's
Um,
it's really funny you talk about that, because one of the biggest things, and going back to January when I was taking a larger public profile, and in all of my speeches, leading up to in the back half of 2019, I too sort of went to smog, because people always said, for One Energy, how did you guys have success? Like, how did you learn the basin? Did you read investor presentations? And I would always laugh. And in data rooms, when they said, like, did you use Aries? I'm like, no, we didn't use Aries. I rebuilt everything from scratch with my own assumptions, because whatever people were putting out, like that first page in an investor presentation that says everything in here is like safe harbor, you shouldn't agree with it, you shouldn't believe it, forward looking, blah, blah, blah. I'm like, that basically rejects the premise of all investor relations. And so I went to the SEC and did the same thing as you did. And what I missed from the EFT guys were, they weren't saying that they were overvalued or undervalued. They were saying that even the SEC reserves were overstated. So it's so much worse than even that suggests. And then I was saying that 95% of oil and gas companies were overvalued, which is fundamentally why there's been no consolidation. Because to your point, Chevron and Exxon are not going to pay cash for an asset that's worth less than the debt. And so then you enter Whiting, who's the first in the Bakken to actually declare Chapter 11. And then last night we saw Chesapeake declare Chapter 11, which was right after Sable Permian, I believe, which was Aubrey's American Energy partner. So within 4 days, the two companies that he founded declared Chapter 11. But they'll convert all that debt to equity, and then presumably they'll be appropriately valued, and equity and debt goes away. Do you think that those guys become consolidators and that there's a first mover advantage, or how do you see those companies playing out?
well, obviously, I don't know, but I mean, last time around in 2016, they declared bankruptcy and they emerged from bankruptcy, and there was investor money, and they went out and did it again. And they kept the same executives that took them down, and most of them got raises, and whatever. I mean, I'm not a corporate governance expert, but that's not what I would do. I'd get rid of the bums and hire some new bums. Not that they would do any better, but the point is that there were people who gave them money, and there were reasons for that. I mean, when oil goes to $30, as it did in 2016, then you don't have to be a genius to figure out it's going to go higher.
Right. If break evens are 60 and the world needs more oil and it needs capital
to keep it up,
it's going to go up.
Okay, so you could have made a lot of money. I mean, if you just bought shares of, name your tight oil company in 2016, early 2016, and you just held it until the end of 2018, you would have made on average like 250%, because the share price is pretty tightly correlated with the oil price. And at the time, there was no particular reason why the oil price wouldn't go back to $50 or $60, because it was just an oversupply problem that needed to be worked through. And so, and as the price reached the marginal value, then the game was over. The casino was closed. You could no longer, and that's when everybody started bitching about free cash flow and all kinds of other things that were absolutely true. But I mean, those were not the reasons. Nobody cared about free cash flow in 2017. They only cared about it when the game was over and they couldn't make any more money. And they said, well, this is the reason we're getting out of these companies, because they're poorly managed.
And ESG and cash flow.
All this, and peak demand and all, that's a bunch of crap. Okay. The reason they got out was because the price of oil had leveled out and it wasn't going any higher, and it was a stock play all along. The public somehow thinks that investors were investing in the company. No, they weren't. They were investing like you invest in a slot machine. They were investing in the share price, and when the share price stopped going up, they got out. Just like you get up from the table when you start losing. Okay, that's just the way it works. And I mean, some people did invest. I mean, the private equity certainly did, but in general, that just wasn't the case. So what's going on today? Well, what's the likely future plateau of oil price? Well, it certainly isn't $60 or $70. I'm not saying oil price will never get back there, but looking out over the next, let's say, year, we're in a global depression. Let's be honest about it.
Oh, absolutely.
And oil
I
prices.
feel like I'm talking to myself, except I feel like you're more handsome and better spoken. So I like this sort of upgrade of me. So carry on. I love it.
I don't know how a 70-year-old guy is better looking than you, David, but whatever. The point is that we are not going to get back to $60 oil anytime in the next year or two. In the best scenario, now it's possible that we could get some spikes. If we get some geopolitical event, I don't see that any more than bombing the refineries that Gawar did. But anything's possible. But it isn't going to last. It's not going to stay there. And so the what I see is prices are going to remain lower than the break even for these companies, and not just the tight oil companies, but all the companies. I mean, the international companies, the national oil companies, everybody's got a big problem. OPEC Plus doesn't do what they do for philanthropic reasons. And it's harder, I suppose, to figure out what those guys actually need. But Saudi Aramco, in 2019, they did an IPO of sorts, and they released a statement. And you can go, it's public information. You can go out there and download it. And by the time so everybody talks about, Saudi Arabia's break-even price is $8.70 a barrel. Well, that's a load of crap. I mean, that's their lifting cost. That's what it costs them to run a compressor, an artificial lift system. You go through that statement, and by the time they pay production taxes, and they do, and they have a staff, and they have hookup expenses and midstream, and they have taxes and all of that, by the time you add it up the same way I do for any U.S. company, they need $40 a barrel. And I've got friends who are Saudi, and they say, oh, no, that's not true. Saudi is a special company. Well, I'm sorry. That's what the information in their equivalent of a 10K says, $40 a barrel. Now, that's better than just about any other company in the world. It is better, but it isn't $8. So if oil is what it is today, Saudi Aramco is at best breaking even, and if they hadn't have cut 10 million barrels a day almost, we'd still be at $20. So, I'm just not big into blaming anybody for anything. I think that's a really infantile way of assessing markets and world events. It is what it is. And what's important to me as a scientist is to describe what is the present configuration of this market. And if I can describe it accurately and can identify the key patterns that seem to be the dominant controls, then I might be able to say what this is going to look like in the next moment or two, which is to say tomorrow or maybe even in 3 months. But in a year or two, now we're in the world of speculation. But still, I go back to what is the present state? What are the main patterns that control the present state? If I don't know that, then I'm just fooling myself about speculating about what I think things are going to do in the future.
So I'll take two pieces from that as we wrap up the conversation. Number one is you sort of talk about a $40 marginal barrel. And I think if you were to have access to the Russian data, it would probably look the same. And that generally, because the US has been extracting oil since the early 1900s at an unbelievable clip, and because we had gone into decline in 1973 until the shales, other countries look more like the US used to look. And so I would say a $40 barrel is about when the conventional plays died. So therefore, ergo, for non-shale players elsewhere in the world, $40 the world. The forward strip for oil looks like $40 for the next, pretty flat for the next 3, 4, 5 years. Natural gas, we talked about a little bit, but it comes in at $1.50, kind of goes to $2.50, which is arguably a marginal MCF. Do you agree with those price forecasts on the margin, excluding spikes, for kind of the next 5 years, that we're in a 40 and 225 world for the next 5 years, do you think?
Well, gas is a little trickier, and so you talk about, 290 or something. That's a January contract price, and it's been coming down. Actually, it's 280 something right now. So, that's going to be a max price for the year. But I mean, a future strip is, to me, it's like any forecast. It is a very useful and concise summary of present thinking about the future. And so people criticize future strips and they say, oh, look how terribly, the August future strip did at predicting the price of oil in January. Well, again, duh. I mean, that was just what people were thinking based on, not thinking, that was what they were putting money on in August. All right, everything changed. Everything changes all the time. And so you got to look at forward curves for what they are. They are a snapshot of capital expenditure today, just like rig counts. People say, oh, rig counts don't mean anything anymore. Well, I totally disagree. But if you don't know what to do with them, well, I guess it's easy to say they don't mean anything.
Right.
So I would say, yes, I agree with you generally that $40, 42, 43, I don't know what it right. I mean, that is what the market seems to believe is the marginal clearing price of a barrel of WTI. That's what it seems to be. And for Brent, it's a little bit higher, not very much.
And so that is really, I mean, it to your overall point, like that is very negative. And so we talked about 2016, and it's funny. We started One Energy in January 2016. We sold in October of 2018. And people always sort of ask the Guy Raz question, was that luck or skill? Well, the skill was identifying the opportunity. The luck was the fact that 2.5 year window, like we literally could not have timed it better by 3 months. And that was less purposeful because the aggregate backdrop has been a 6-year bear market. And so what do you say to people who say, well, look, oil's 30 or 40 and everyone's marginal cost is 40, so the world is going to decline and gas is going to decline because they can't have capital activity, and the best cure for low prices is low prices, so oil is going to go back to 60, so we're on the verge of this super commodity bull cycle. Eric Nuttall, who I'm sure you see on Twitter, would say that, and some other energy bulls say we're going into this super cycle and everyone's going to make money. Why is it different now with low prices than in 2016 when the same action worked?
Because we're in a global depression. It's real straightforward. And again, this notion of cyclicity, based on what? I mean, are these cosmic cycles, or are they based on data? Because I just don't believe that there are cosmic cycles. I mean, it all gets down to human behavior, and most of it in the oil business and the gas business is about producer behavior. And so, I mean, 99% of what people talk about on Twitter is demand, which just blows my mind because markets only care about supply. I mean, they may talk a lot about demand, but I mean, price is what's used by the market to either accelerate or decelerate drilling. Supply. It's a supply constrained market, which is not to say demand doesn't matter, but that's just what the market does. And so, yeah, we're in a depression, and that doesn't change everything. It's just a very different present moment circumstance than we had in 2016. That's all I'm saying. And so people who imagine a super cycle, they're going to have to tell me where the money's going to come from. Now, certainly the price of oil is going to go to $60 or $100 or something sometime out there. I mean, it is the master resource of the planet. And for as much as, I would like to agree with my colleagues, I think we're going to go to an all-electric economy. There's no way we're doing that because it just doesn't have the productivity that we need, at least not in the foreseeable future. And so at some point, the price will go up. I'm just saying that I don't see the circumstances in the relatively near term, which is to say the next year or so, that we're entering a super cycle that prices are going to go up. Now, by saying that, I'm probably wrong, but I would be surprised if I'm very wrong.
Would you agree that the biggest risk factor for the fundamentals of the argument that you just made is the Fed? And that the Fed has at every turn, every time the stock market has gone down, they have bolstered liquidity to ensure a risk-on trade, and that the risk-on trade tends to move people into an oil and gas. Like we saw that bull run, that massive spike up in the last kind of month where it went from dead to stocks were up 400% and now they've kind of trickled down. Is that the biggest risk factor, is how the Fed responds to this global depression, which I also agree with you that we're in?
Well, not just the Fed, but the central banks of the world and the treasuries of the world, that if they don't support the livelihood of all the people that are out of work, then the financial system will collapse. I mean, at some point, a lot of people say, oh, look, oil demand is coming back, at the speed of light. Well, okay, most of that's gasoline, and that's because people are driving around, but people are driving around, which is not particularly productive economic activity, but people are driving around because they're getting $600 a week from the government, and they're not paying their mortgage, and they're not paying their auto loan, and, et cetera, et cetera. All right. So if that support drops away, they're not going to be driving around anymore. And that's something, I'm not saying that to be negative. I mean, it's just
the reality.
It is. Okay.
Yeah.
So, and I don't really, it's not that I don't care about gasoline demand. I look at diesel demand because diesel reflects orders, economic activity, and that's in the toilet. I mean, that's, until that starts looking good, I'm not too enthusiastic. But I disagree. I don't think I disagree with anything you said, but I disagree with the argument that the whole shale phenomenon was because of monetary policy. The shale phenomenon occurred because oil and gas price was high, pure and simple. Now, a zero interest rate or nearly zero interest rate, sure, it helped. Absolutely, it helped. Did quantitative easing, did the creation of liquidity, did that help? Yeah, of course it helped. But if oil and gas prices weren't high to begin with,
yeah,
wouldn't have made that much difference. And oil and gas prices were high because markets perceived that there were shortages, which there were, of both oil and gas at the beginning of this century. And going back to what I said before, what do markets do when they want to stimulate activity? They raise the price, and it worked. Okay, they raised the price, and people, reinvented hydraulic fracturing and horizontal drilling, and markets were still nervous all the way through 2013. Well, maybe we don't have enough yet, and eventually we had too much, and the price went down. But I think it's a mistake to divorce. I mean, all these factors matter, but ultimately It's the market's perception of, do we have adequate supply, that drives price. Right now, the market's judgment is, hell yeah, we got adequate supply. And so for those who think that the price is going up, I say, show me why.
Yeah.
Show me what about supply looks inadequate in, pick your time frame. And if you want to pick 10 years, we can have a great discussion over a beer. That's great. But if we're talking about, some reasonable period where we think we sort of know what the constraints are, I say, well, it's a nice idea. And maybe you're right, but I don't think so. Not based on the data that I have today.
And I agree with you. So last question for you. You said you're 70. If you could go back to 25-year-old Art and give 25-year-old Art advice that maybe, I don't want to say change the outcome, because I think anyone who's had a happy life would not change a single thing in terms of where they are today. But what advice would you give yourself that might have made it easier or had a meaningful impact on where you are today? Maybe self-awareness or awareness of something. What would you tell yourself?
Well, we'd have to have a much longer conversation about the personal and the psychological part of that, which I could give myself a ton of advice on. But actually on the business side, I was paid to be a geologist for a big oil company, and I was paid to keep my nose right in the area I was working on and be smart about the tools I used. I would have said, pay more attention to the broader universe of what's happening in oil and natural gas markets and in financial markets and economics in general. I probably would have gotten my hands slapped had I done that. But I was relatively ignorant, even though I lived through a lot of that stuff, of all of those things, until I finally broke or was broken from the big oil company at the end of the 1990s. And I had to learn it myself. And that changed my perspective immeasurably. And I don't think it made me a better geologist, but it made me a broader geologist. So that would have been the advice I would have given myself.
Well,
I wouldn't go back to 25. No way.
Yeah, I'm with you. I am with you. Well, Art, phenomenal conversation. For those who don't follow, if you're not following him after this conversation, I think you probably don't like oil and gas, and you don't like to expand your knowledge base. So I would strongly encourage you to go to artberman.com and sign up for the newsletter. He has some great services, and I really value what you put out in the universe. I really valued this conversation, and I feel very fortunate to have got to have this conversation. So until next time, thanks so much for joining us, Art. I really appreciated it.
Yeah, great to talk to you, David. All the best.
Great. Until next time, be safe, be good, have a great day, and bye for now.